The Monetary Policy Committee, that is the MPC, met on 6th, 7th and 8th February. Based on an assessment of the macroeconomic situation and its outlook, the MPC decided by a majority of 4 members out of 6 to increase the policy repo rate by 25 basis points to 6.5% with immediate effect. Consequently, the standing deposit facility, that is SDF rate, will stand revised to 6.25%, and the marginal standing facility, that is the MSF rate, and the bank rate to 6.75%. The MPC also decided by a majority of 4 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. Let me now explain the MPC's rationale for these decisions on the policy rate and the stance. The global economic outlook does not look as grim now as it did a few months ago. Growth prospects in major economies have improved, while inflation is on a descent, though inflation still remains well above the target in major economies. The situation remains fluid and uncertain. Reflecting this recent optimism, the IMF has revised upwards the global growth estimates for 2022 and 2023. As price pressures wane, several central banks have opted for slower rate hikes or pauses. The US dollar has retreated sharply from its highest level in 2 decades. Tighter financial conditions caused by aggressive monetary policy actions, volatile financial markets, debt distress, protracted geopolitical tensions, and fragmentation continue to impart high uncertainty to the outlook for the global economy. Amidst these volatile global developments, the Indian economy remains resilient. Real GDP growth is estimated at 7% in 2022-23, according to the first advance estimate of the National Statistical Office, that is the NSO. Higher rabi acreage, sustained urban demand, improving rural demand, robust credit expansion, gains in consumer and business optimism, and the government's enhanced thrust on capital expenditure and infrastructure in the recently presented Union Budget 23-24 should support economic activity in the coming year. Weak external demand and the uncertain global environment, however, would be a drag on the domestic growth prospects. Consumer price inflation in India moved below the upper tolerance level during November and December 2022, driven by a strong decline in prices of vegetables. Core inflation, however, remains sticky. Looking ahead, while inflation is expected to moderate in 2023-24, it is likely to rule above the 4% target. The outlook is clouded by continuing uncertainties from geopolitical tensions, global financial market volatility, rising non-oil commodity prices, and volatile crude oil prices. At the same time, economic activity in India is expected to hold up well. The rate hikes since May 2022 are still working their way through the system. On balance, the MPC was of the view that further calibrated monetary policy action is warranted to keep inflation expectations anchored, break the persistence of core inflation, and thereby strengthen the medium-term growth prospects. Accordingly, the MPC decided to raise policy repo rate by 25 basis points to 6.5%. The MPC will continue to maintain strong vigil on the evolving inflation outlook so as to ensure that it remains within the tolerance band and progressively aligns with the target. Inflation is expected to average 5.6% in the fourth quarter of 23-24, while the policy repo rate is, after today's revision, now stands at 6.5%. Adjusted for inflation, the policy rate still trails its pre-pandemic levels. liquidity remains in surplus with an average daily absorption of 1.6 lakh crore under the LAF in January 23. The overall monetary conditions therefore remain accommodative, and hence the MPC decided to remain focused on withdrawal of accommodation. I would now like to provide our assessment of growth and inflation. First, I would like to take up growth. Available data for Q3 and Q4 of the current financial year, that is 22-23, indicate that economic activity in India remains resilient. Urban consumption demand has been firming up, driven by sustained recovery in discretionary spending, especially on services such as travel, tourism, and hospitality. Passenger vehicle sales and domestic air passenger traffic posted robust year-on-year growth. Domestic air passenger traffic crossed pre-pandemic levels for the first time in December 2022. Rural demand continues to show signs of improvement as tractor sales and two-wheeler sales expanded in December. Several high-frequency indicators also point towards strengthening of activity. I have listed out some of the high-frequency indicators which show improvement and strengthening of activity in the footnote of my statement. As you know, the statement will be uploaded in the RBI website. So if you are interested, you may like to have a look at it. Investment activity continues to gain traction. Non-food bank credit expanded by 16.7% as on January 27, 2023. The total flow of resources to the commercial sector has increased by rupees 20.8 lakh crore during 22-23 so far, as against 12.5 lakh crore rupees a year ago. Indicators of fixed investment, that is cement output, steel consumption, and production and import of capital goods registered robust growth in November and December. In several sectors such as cement, steel, mining and chemicals, there are signs that additional capacity is being created in the private sector. According to the RBI survey, seasonally adjusted capacity utilization increased to 74.5% in Q2 22-23. The drag from the net external demand, on the other hand, continued as merchandise exports contracted in Q3 22-23. On the supply side, agricultural activity remains strong with good rabi sowing, higher reservoir levels, good soil moisture, favorable winter temperature, and comfortable availability of fertilizers. PMI manufacturing and PMI services remained in expansion at 55.4 and 57.2 respectively in January 23. Turning to the outlook, the expected higher rabi output has improved the prospects of agriculture and rural demand. The sustained rebound in contact-intensive sectors should support urban consumption. Broad-based credit growth, improved capacity utilization, government's thrust on capital expenditure and infrastructure in the union budget recently presented should bolster investment activity. Let me repeat, broad-based credit growth, improving capacity utilization, government's thrust on capital spending and infrastructure should bolster investment activity. According to our surveys, manufacturing, services and infrastructure sector firms are optimistic about the business outlook. On the other hand, protracted geopolitical tensions, tightening global financial conditions, and slowing external demand may continue as downside risks to domestic output. Taking all these factors into consideration, the real GDP growth for 2023-24 is projected at 6.4%.